A very common question we get on the channel is how much do I need to qualify for $1 million home? Well, in this video, I'm going to show you exactly how to do that using the VA home loan benefit. So that way you know exactly what type of income you're going to potentially be needing in order to get a VA loan on luxury property in 2025. So let's dive right into the numbers. So I have $1 million entered into our purchase price and then appraised value at 1 million and our loan amount at 1 million because as you know, there is no down payment requirement on the VA home loan benefit. So this allows you to obviously not have to worry about bringing in a down payment along with closing costs. Now, speaking of closing costs, even though the VA loan does not have a down payment requirement, there are still going to be closing costs on the VA loan. This is one thing that many veterans mistake when going through the buying process is their thought is they don't need to bring in anything up front in order to purchase a home. And that is not true. Closing costs exist on all loan types, even if you are a disabled veteran. So it is important to remember that you're more than likely going to be needing a certain amount of funds available for you to be able to close on that home. Now, sure, there are instances where you could get your closing costs covered by someone else, whether that be from the seller, your builder, even maybe getting a credit from your lender and your realtor to help cover those closing costs. But remember this, even though someone gave you a credit to cover them for you does not mean that they didn't exist. So you want to make sure you understand what those numbers look like. In 2025, I've been seeing closing costs range from between about 3% to as high as 4%. And it does depend on first where you're located geographically and also really also depends on the price point. The higher the price point, I have seen actually closing costs be a little bit lower. So you'll probably be closer to the 3% range, but the lower the price point, they are going to be a little bit higher. Now, let's dive into what some of these numbers look like just to give you an idea. What I wanted to do was get some general numbers here. So, again, we have our $1 million purchase price, appraised value, and base loan amount. And then there's another thing that we need to keep in mind of is if you are a disabled veteran or not. So, if you're collecting via disability of a 10% rating or more, you do not have a funding fee, which means you would be exempt from the funding fee that gets rolled into your loan. Now, if you are a first time use of a veteran and you are not exempt from the funding fee, then the funding fee is 2.15% of your loan amount. Hence why on $1 million property, it asks for 21,500 because that is 2.15% of what this loan amount would be. Now, again, this gets rolled into your total loan, which make the total loan slightly higher than the purchase price of the home that you're buying in order to allow you to pay the funding fee over time versus trying to come up with all $21,000 at one time. If you are using the VA loan for a subsequent time and also not exempt from the VA loan, this is going to increase the funding fee to 3.3%. So subsequent use is going to be really anything more than the first time. And on subsequent use, your funding fee is 3.3%. Now, in this situation, if you are collecting via disability of a 10% rating or more, just remember you are exempt whether it's your first, second, third, or however many times you're potentially using the loan. So what I'm going to do, I'm going to act like you are exempt from the VA funding fee so that it gives us a flat loan amount of $1 million here. And then I wanted to use national average data for our taxes and insurance. So recently, there are some states that are higher than this for property taxes on a monthly basis, and there's some states that are lower. But I wanted to kind of split the difference to give you a rough number of what that payment would look like. And so if this property does not have an HOA and you're just factoring in principal, interest, taxes, and insurance, which is called PITI, you're looking at roughly a payment of $7,500 using an interest rate of about 6%. And that's also just going off of really where national averages are. So national averages on a VA 30-year fixed as of 10/13, which is the time that I'm recording this video, right at about 6.04%. Now, if you're wanting to keep up with national average data to get an idea of how rates look, I post this every single day on my channel. All you have to do is go to my channel page and then click on posts, otherwise known as community posts, and you will be able to check out exactly how rates were looking from that given day. And also, there's an article there for you to check out as to why certain decisions were made in terms of how they affected pricing for that given day. Back to our file here, we have our rough monthly payment, but now we need to figure out, well, how much do you need to make in order to qualify? There's one major thing we need to factor in here, and that's going to be household size. On a VA loan does not really use debt to income ratio to determine your final decision. It's going to use household size, and household size would be listed right here under dependents. Now, if this person was married, I called our buyer Major Payne. If Major Payne was married, but the spouse was not on the loan, then we would list them here. If Major Payne had children, we would list them there as well. So as an example, let's say that Major Payne has 4 dependents, which would be, let's say, their spouse and 2 children. And I'm actually kind of using this as my example here. And then we would put the spouse's age. Let's say the spouse is 30. And then let's say that they have one child that is 4 years old and another child that is 1 year old. So they have, or excuse me, I put that all wrong. We should put three because they're a household of four, including themselves. And then what we're doing is we're coming over to this VA loan analysis. Now, on the VA loan analysis, it requires some things to be listed on here. Gross monthly income, which we have nothing listed at the moment. We'll get to in a second. It has our proposed monthly payment based on the details that we just talked about. It has our monthly debts and obligations, which we have nothing listed at the moment. And then it has monthly maintenance and utilities, which this is based off of the square footage of the home. Now, monthly maintenance is not a actual bill that you're paying or something that gets added onto your loan amount. Think of it as something that is a buffer that is used in order for making sure that you qualify and have enough money left over. So that's all that's going to be there for. So monthly maintenance is based on the square footage of the home. So let's say as a $1 million property, you're probably looking at a 2,500 to possibly even bigger home, depending on what part of the country that you live in. So for this example, let's just say it's 2,500 square feet. Then in this situation, it factors in 350 against your residual income. But if you're doing, let's say, a 3,000 square foot home, it factors in 420. So for the sake of this example, I'm going to do 2,500 square feet. Now, when we come down here, we have our residual income chart. And our residual income chart is based off of first where you're located geographically. You have Northeast, Midwest, South, and West. Then you have the household size. Depending on the household size is how much the VA wants you to have left over. Now, I live in the southern region, which is what I'm going off of, and I have a household of 4. So the VA says I need to have $1,003 left over after all of my bills are paid, including my new potential mortgage. Now, if I'm currently renting, we're not counting that rental payment as a debt. We're only counting the debts that will continue or exist when we close on this home. So that's one thing we need to factor in. But there's also going to be a change in this number. So we'll talk about that here in a second. Okay, so let's come over to our financial info so that way we can get a better idea of what income needs to be in order to qualify for this loan amount. So we know exactly what the payment is, but how much money do you need to make realistically to make this work? Let's use one form of income as VA compensation. VA compensation would be, let's say at 100%, it's going to be about, I would say $4,200 for this type of household. But with VA compensation, the VA allows you to do a little thing called grossing up. And grossing up allows you to increase the amount that you're going to or are receiving by 25%. So as an example, we get to take this number here and we get to take it and add 25%. That's 5,250. So, and then I'm going to subtract the 4,200. That's 1,050. So that's how much we grossed up by. So we're going to put the number in here as the amount that's being received. So now we have a debt to income ratio showing up. We're 172%, which is not good, as we're well off right now because this is not enough income at the moment. We're going to add in some additional income as well. The other thing we're going to do is let's say that they also have a job, and let's say that that job has a base salary. So I'm going to put TBD as to be determined, and I'm going to put TBD here. I just put in a bunch of numbers here for, need one more one. And then let's say that they have been at this job or in this line of work for at least 2 years. So I'm going to do October 1st, 2023. Now I'm going to add in monthly income of, let's start with $5,000. So we have our monthly income of $5,000. Our debt to income ratio is now 88%. So we're getting closer. I don't think this is going to be enough income yet, but let's see what happens. So let's come over to our VA loan analysis, and we're going to take a look at some things. Now, currently on our VA loan analysis, it is factoring in that we technically do meet residual. You see, the VA wants you to have $1,003 left over, but you're going to notice that the amount that's left over currently is $2,362.83. But you're probably wondering, what's this little number right here in the middle? What does this mean? Well, anytime that you have a debt to income ratio of greater than 41% is when the VA adjusts how much money they want you to have left over. This is actually the only time the debt to income ratio is factored in on a VA loan. It's not factored in to make a final decision. It's factored in to make an adjustment to your residual income. So for example, what we would have to do is we would have to take your residual income requirement of $1,003 and we would add 20% to that, and it would bring $1,203.60, which is the number you see there. This is an increase in the requirement only if your debt to income ratio is greater than 41%. In this situation, currently, we're at 88%, which means we need to have an increased amount, which if you're reading this, you're probably thinking, well, I do. So that's all I need. All I would need is roughly about $10,000 per month to qualify for that house. No, we're not there yet. So you remember we grossed up your VA disability? Yes, it does allow you to gross it up by 25%, but this is where people get it mistaken and make a huge mistake in thinking that they qualify for more than they do. When you gross up your VA disability in order to lower your debt to income ratio, I want to show you what this does as an example, okay? So let's go to your VA disability. Let's put in what you actually are receiving. For rule of thumb, the grossed up amount got you to 88%. But if you put in what you are currently receiving and we do 4,200 bucks, your debt to income ratio now goes up to 98%. That's a 10% difference in this situation. So that's helping massive amounts, but that can only help the debt to income ratio. It cannot help your residual income ratio. So how do we fix this? How we do it is we go and look at how much was grossed up. In this situation, it was 1,050. And we go over the VA loan analysis, and under this local tax, we add in 1,050. So now you see the residual income that's left over is now 1,312. So at the moment, you do meet residual. That's a good thing. But there's another thing we're missing here. You see, there's monthly taxes on any taxable income. And in this situation, we used our to be determined income. Even though you're making a $5,000 salary, this is actually a taxable income. So we would have to calculate how much in taxes you're paying monthly based on federal, state, if the state you're living in has them, Social Security, all those things get added to the VA loan analysis. So if we go and do that, let's look and see, do you still meet residual? Okay, so we got our paycheck calculator here. I'm using the state of Texas because that's just where I live as my example, and it also allow me to not have to count in state income taxes. And I'm already knowing someone's going to mention this, but so I just want to make sure that I explain this in the chat. I know that in the state of Texas, if you are a 100% disabled veteran, you do not have to pay property taxes, so this monthly payment would go down. I'm well aware of that, but this video is not specific to Texas. It's more specific to the overall country. So I want to make sure that you guys, we're all on the same page here. You guys see this video and understand that I'm trying to give a breakdown to everyone to get it as most accurate as I possibly can, not just for states where someone's collecting or does not have to worry about property taxes. Okay. All right. So let's come back over to our paycheck calculator, and we're going to do gross monthly income of $5,000. So I need to change that to pay period, change that to monthly, and then we're going to hit calculate. And it tells us that our federal withholding is $430.13. Okay. So we're going to do $430.13. Now I know we don't have any state income tax, but we have Social Security of $310. So we're going to add that in right there. And now look at that. We have a red number here. $572.70 is left over, and we need at least $1,203.60. So we actually do not meet residual in this situation. So now we need to increase that income. So let's come back over to our scenario or our financial info, and let's look and see how much more we need to increase this. Now we're gonna say that, let's say this is $7,500. This is $7,500 a month, and then we're gonna come back over to our paycheck calculator. We're gonna do 7,500, hit calculate, 951.17. We need to change our Social Security to 465. Look at that. Now we're getting good. Now we're looking much better here. So based on what we have here, we're looking at a salary of $7,500 a month, and we're also looking at VA disability of $5,200 a month, which is roughly gross monthly income of $12,750. But this is also not factoring in any monthly debts, right? Our debt to income ratio, 70%, right? So it's pretty high, but as per our VA loan analysis, we meet VA's residual income guideline. Now, what would it have to be if all of our income was taxable income? Because remember, you're not paying taxes on this income, right? This $4,200 you're not paying taxes on. On the VA loan analysis, we're just reducing, we just took out only what was being grossed up. Everything else was left in there. So what would that number need to be if all of your income was taxable income? So I just took out your VA disability. Our debt to income ratio just jumped up to 120, right? So let's just add on another $5,000 a month. Let's say that our income was $12,500. Okay. Then we get to go back to our VA loan analysis. We're going to remove the amount that we grossed up, and then we're going to go back over here to our calculator. We're going to do 12,500. Okay. We'll hit calculate. We got federal taxes of $2103.92, and Social Security is at $775. But the other thing we need to do is, because we're not collecting VA disability, so we need to now add in the funding fee, right? So we're going to do first time use. Not going to make it too brutal. Okay, that's not what I wanted. I wanted first time. There we go. 1,021,500. Perfect. And then we come back over to our VA loan analysis, and we meet residual. Look at that. 73% debt to income ratio, so slightly higher, but we meet residual in this situation. So based on what I'm looking at here, based on current interest rates, based as of 2025 in October, at $1 million property, you're looking at $12,500 per month minimum in order to really qualify for $1 million property. As soon as you start adding in monthly liabilities, like let's say you have a auto loan. Auto loan would be an installment, and that auto loan has let's say it's a $700 payment, which you'd be surprised what the average monthly payment is that I'm seeing right now. I don't know what kind of balance that would be. Let's say it's 50,000. I feel like cars are just getting more and more expensive. You add in that auto loan, right? Our debt to income ratio jumps to 78%. And then we go back to our residual income and look at that. We no longer meet residual, which means our income would need to be higher. You see where I'm going? So just keep these things in mind. I wanted to make this video. It's organic as I possibly can make it. I'm probably not going to do any editing to this video, to be honest with you guys, because I just wanted to show you guys roughly what it looks like in terms of qualifying income that you need to have in order to qualify for a $1 million property. So if this video was helpful to you, do me a favor, hit the like and subscribe to the channel if you're not already. And also, if there is a payment that you want me to run for you guys, like a purchase price that you're wondering that I could run for you, let me know. Keep in mind, I will make it as general as I possibly can because I want to make it as valuable to as many people as we possibly can make it. But if there's a purchase price you want me to run for you, let me know down below in the comments. Let me know what purchase price you're looking at. And also if you want me to factor in, different property types as well, I can do my best to provide you that information to you guys as well. But the last thing I want to leave you with is always the most important thing on this channel, and that's Jesus loves you and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan of purpose for you. I'll see you guys in the next one.